2026 has been a brutal year for a lot of investors, and I mean that in the most instructive way possible. Markets have been volatile, growth and technology stocks have taken significant hits, the Nasdaq has fallen harder than the S&P 500, geopolitical uncertainty has been a constant background noise. And for income investors specifically, people who depend on covered call ETFs to generate monthly cash flow from their portfolios, this year has been one of the most revealing stress tests we've seen in a long time. Because here's the thing about market volatility that most people don't fully appreciate until they live through it. It doesn't just test your emotional discipline, it tests your funds. It exposes which covered call ETFs are actually built to survive difficult market environments, protecting NAV, maintaining distribution stability, and still delivering meaningful total returns, and which ones only look good when everything is going up. And right now, after months of navigating exactly this kind of environment, we have real data, real results, real answers. Welcome back to Dividend Desk. Today we are doing a full breakdown of the best high-yield covered call ETFs of 2026. We are going across the entire landscape: index funds, sector-specific funds, single-stock ETFs, and target income funds. We are looking at total returns, NAV resilience, distribution stability, and what each category of fund actually means for income investors building portfolios they want to live off of. This is one of the most data-driven videos we've done on this channel, and if you own any covered call ETF right now, or you're thinking about adding one, this is exactly the kind of analysis you need to be doing. Let's get into it. Quick disclaimer: nothing in this video is financial advice. Everything here is for educational and informational purposes only. I am not a financial advisor. Always do your own research and consult a qualified professional before making any investment decisions. No company mentioned in this video has sponsored this content. Everything you're about to hear is my honest, independent analysis. Part 1. Setting the stage. Why 2026 is the perfect test. Before we get into the rankings and the numbers, I want to spend a moment on why this particular moment in time is such a valuable opportunity to evaluate covered call funds. When markets are in a sustained bull run, when everything is going up and volatility is low, it is genuinely difficult to distinguish between a well-constructed covered call fund and a poorly constructed one. In a rising market, almost everything looks good. NAV holds up because the underlying assets are appreciating. Distributions get paid because premiums are being harvested and stocks are going up. Investors are happy. And the differences between funds that are genuinely engineered well and funds that are just riding the wave get masked by the tide lifting everything. But when markets get choppy, when we have the kind of environment we've experienced in 2026, with sector rotations, geopolitical disruptions, significant drawdowns in growth and technology, and elevated uncertainty across the board, that is when the engineering of a fund gets revealed. That is when you find out which funds were truly built to protect NAV during declines, maintain distribution stability through volatility, and still deliver competitive total returns even when conditions are difficult. Out of the approximately 152 covered call ETFs that currently exist in the market, we are going to look at the ones that have risen to the top, and we are going to look at some that have not held up as well as their marketing might have suggested, because both pieces of information are valuable for building a smarter income portfolio. Part 2. The top 10 best performing covered call ETFs of 2026. Let's start at the top. These are the 10 best performing covered call ETFs of 2026 on a total return basis, assuming distributions were reinvested. Coming in at number 10 is the REX Core Weave Growth and Income Fund. At number 9, the Yield Max Circle Internet Group ETF. Number 8 is the REX Income Max Fund. At number 7, the FT Energy Income ETF. In 6th place, the Westwood Energy Income ETF. Number 5 is the State Street Energy Select Income ETF. 4th place goes to the Bitwise GameStop Income ETF. At number 3, the YieldMax Semiconductor ETF. 2nd place goes to the YieldMax Exxon Income ETF. And coming in 1st place for 2026 is the YieldMax mRNA Income ETF, ticker MRNY. Now before you start rearranging your portfolio based on this list, I want to make some important observations. Because this top 10 list is informative, but it also comes with significant caveats that you absolutely need to understand before drawing any conclusions. The first thing to notice is the two sectors dominating this list: energy and AI-adjacent plays. Both sectors have performed strongly in 2026 relative to the broader market, and covered call funds built on those underlying assets have naturally benefited from that tailwind. This is an important reminder that the performance of a covered call ETF is fundamentally tied to the performance of whatever underlying assets it holds. A covered call strategy does not create alpha out of thin air. It generates income on top of the underlying exposure. If the underlying is doing well, the fund tends to do well. The second and more important observation: out of these top 10 performers, only the top 7 have experienced zero NAV erosion in 2026. The bottom 3 on this list, despite being top 10 performers on total return, have actually seen their NAV decline, and Croc, despite being in the top 10, has had its NAV decline by over 11% year to date. That is a significant erosion of the fund's foundation, and it matters enormously for income investors who are not reinvesting distributions. The third observation is one I want to spend some real time on. 5 of these 10 funds are single stock ETFs. Half of the top 10 is only exposed to the share price movements of a single company, and that brings me to one of the most important warnings I can give any income investor. Part 3. The single stock ETF warning: why the top performer tells a cautionary tale. Let's use the number 1 performer, MRNY, the YieldMax mRNA Income ETF, as a case study because it perfectly illustrates both the opportunity and the danger of single-stock income ETFs. On a year-to-date basis in 2026, MRNY has a total return of 59.17%, with its share price up 26.05%. Those are genuinely impressive numbers, and they will catch people's attention. They will cause some investors to look at that return and start allocating a meaningful portion of their portfolio into this fund. But here is what you absolutely must know before you do that. If you zoom out beyond 2026 and look at MRNY's performance since it first launched, the picture changes dramatically. The share price of this fund is down almost 90% since inception. Let that sink in. Almost 90% share price decline since launch. Even on a total return basis and with all distributions reinvested, the fund has returned 50.75% since it launched, which means that an investor who has held MRNY since inception and reinvested every single distribution is up just over 50% in total. That's not terrible, but it's a very modest return for an investment that advertises massive monthly income, and it comes with the psychological reality of watching your share price fall nearly 90%. What this tells us is simple: MRNY is having a genuinely good year in 2026. That's real. But it is not a reliable all-weather income vehicle. It is a single-company bet on Moderna, a highly volatile biotech stock, and its performance will swing wildly based on what happens to that one company. Good year for Moderna. MRNY can look like a genius play. Bad year for Moderna? The fund can devastate your portfolio. This is the fundamental risk of single-stock covered call ETFs, and it applies across the category, not just to MRNY, but to any fund that is only exposed to the price movements of one company. My strong recommendation: it is absolutely fine to have a small, considered allocation to a single-stock ETF if you have genuine conviction about that company's outlook. But please, do not allocate 20%, 30%, or more of your income portfolio into any single one of these. The concentration risk is simply too high for a portfolio that you want to be durable and dependable over time. The covered call funds that are genuinely built for long-term income investors, investor, the ones you can rely on as a core holding, on the are the broadly diversified funds. The ones that hold a collection of stocks across an index or sector rather than betting everything on one company's share price. That diversification is not just a nice to have, it is the difference between an income strategy and a speculation strategy. Part 4. The best S&P 500 covered call ETFs of 2026. Let's move into the index covered call funds, starting with the S&P 500 category. These are the funds that use covered call strategies on holdings inside the S&P 500 index, and they represent the core of most income investors' covered call allocations. The funds we are comparing here are the NEOS S&P 500 High Income ETF ticker SPYI, the ProShares S&P 500 High Income ETF ticker ISPY, the TAP Alpha SPY Growth and Daily Income ETF ticker TSPY, the Goldman Sachs S&P 500 Premium Income ETF ticker GPIX, and the Roundhill S&P 500 Covered Call ETF ticker XDTE. One quick note, I am not including JEPI in this comparison. Despite holding mostly S&P 500 stocks, JEPI also adds equity-linked notes to its portfolio, which means it doesn't fit cleanly into the index-covered call category. We will look at it separately in a moment. Now, given that the market has been down this year, all of these funds are currently in the red on share price. The question is, by how much? Because the funds that have done the best job of limiting NAV decline in a down market are demonstrating something genuinely valuable about their construction. On NAV resilience, meaning which funds have lost the least share price, Goldman Sachs GPIX comes in first, followed very closely by ProShares ISPY, and then NEOS SPYI just slightly behind. Roundhill's XDTE is in fourth and TAP Alpha's TSPY is in fifth. But here is where it gets interesting and where you have to be careful about how you define best. GPIX and ISPY have done the best job protecting share price, but the trade-off for that is significantly lower yield. GPIX yields approximately 8.5%, which is solid, but meaningfully lower than the competition. ISP yields even less than that, and barely beats the performance of just holding SPY directly, so you're giving up significant income in exchange for marginally better share price behavior. NEOS SPYI, on the other hand, yields over 12% and still comes in third on NAV resilience. That is a compelling combination. You are getting one of the highest income streams in this category while still demonstrating meaningful share price resilience compared to the higher yielding but more NAV-sensitive alternatives like XDTE. When we look at total return, which is the number that actually matters most and accounts for both share price movement and distributions received, GPIX comes in first, XDTE jumps to second, ISPY is third, and SPYI and TSPY follow. The fact that XDTE lands second on total return despite having the second worst share price performance illustrates the power of its higher dividend yield in compensating for price decline. So what's the takeaway for S&P 500 covered call funds? If your primary goal is share price appreciation, and you want the most defensive, NAV-protective option, GPIX and ISPY deserve consideration, but understand that you are sacrificing meaningful income to get there. If you want the best blend of high income and still reasonable NAV protection in a challenging market, SPYI by NEOS stands out as the most balanced option in this category. It delivers a genuinely high yield while still holding up better than the more aggressive income-focused alternatives. Part 5. The best NASDAQ covered call ETFs of 2026. Now let's look at the NASDAQ covered call category. These funds operate similarly to the S&P 500 category, but because the NASDAQ 100 is inherently more volatile than the S&P 500, these funds can generate higher option premiums, which means higher distribution yields. The funds we are comparing here: QQQI by NEOS, ProShares IQQQ, TAP Alpha's TQQQQ, Covered Call Fund TACQ, Roundhill's QDTE, and Goldman Sachs GPIQ. The NASDAQ has declined harder than the S&P 500 this year, so all of these funds are more deeply in the red on share price. The rankings tell a similar story to the S&P 500 category. EQI, IQQQ, and GPIQ have done the best job battling NAV erosion, while QQQI, QDTE, and TACQ have experienced more share price pressure. On total return, again the number that matters most, Goldman's GPIQ leads the category, followed by QQQI by NEOS, and then QDTE by Roundhill. The conclusion here mirrors what we found in the S&P 500 space. Goldman's fund does the best job protecting share price, but at the cost of lower yield. QQQI by NEOS represents the best blended option, offering a genuinely high yield while still maintaining competitive total returns. None of these funds are performing badly in the context of a difficult market for the NASDAQ. The differences are meaningful, but not extreme. Part 6. Where do GP and JEEP fit in? Now let's bring in GP and JEEP, the two JP Morgan covered call funds, for comparison. As I mentioned, these are not pure index funds because they both incorporate equity-linked notes into their portfolios. But they are important enough that no covered call ETF conversation is complete without addressing them. Both JP Morgan funds are designed around a more defensive philosophy. They select lower volatility stocks and structure their income generation to prioritize stability over maximum yield. And in 2026, that philosophy has paid off significantly. JPY has actually outperformed the S&P 500 on a total return basis. JPQ has outperformed the NASDAQ 100. Both funds are demonstrating exactly what they were designed to do: hold up better than their respective indexes during difficult market conditions. There is a trade-off worth noting, however. JPY's yield can swing quite dramatically, ranging from roughly 6.5% to 10%, depending on market conditions and the premiums available in a given period. That variability can be a challenge for investors who are depending on consistent monthly income to cover fixed expenses. So while both JP Morgan funds have excellent defensive credentials and have earned their strong reputations, the income variability is something income-focused investors need to factor into their planning. The broader point: during bull markets, both JPY and JPQ tend to underperform because their lower volatility holdings don't capture as much upside. But in environments like 2026, volatile, uncertain, with meaningful drawdowns in growth stocks, these are exactly the conditions where both funds shine. Part 7. Target Income ETFs, a reality check. Let's spend some time on the Target Income ETF category, because I think this is one of the most important segments of the covered call market to scrutinize right now. These are funds that promise to deliver a specific, predetermined yield, usually set at 15% or 20% annually, regardless of what market conditions look like. And 2026 is essentially the first real stress test many of these funds have faced. The two Defiance Target Income funds, SBT targeting 20% on the S&P 500 and QQQT targeting 20% on the NASDAQ, have been widely watched since launch. The results in 2029 are mixed. On a total return basis with distributions reinvested, SPYT is actually beating the market. That is a genuinely positive result. QQQT is slightly lagging QQQ on total return, but not dramatically so. However, and this is a critical these results assume you are reinvesting your distributions. And here is the uncomfortable truth: most people who invest in target income ETFs are not doing that. They bought a 20% yield fund precisely because they want to spend that 20% yield. They want to use that income for living expenses, for supplementing their cash flow, for covering a mortgage or car payment. Reinvesting is the opposite of what they came to this fund to do. And for those investors who are spending the distributions rather than reinvesting them, the picture is less encouraging. Both SPYT and QQQT have seen their distribution amounts decline in 2026. That means the income these funds are delivering is falling, which is exactly the opposite of what target income funds are supposed to do. They are supposed to maintain their stated yield. If the yield is falling while the share price is also declining, income investors are getting squeezed from both directions simultaneously. I am genuinely not impressed by these results, and I think investors who chose these funds specifically for income stability deserve to know that the performance in a real stress test environment has been underwhelming. The VistaShares Target Income funds tell a somewhat more encouraging story. Their Target 15 USA Quality Income ETF, ticker QSUSA, which selects a basket of quality stocks and targets a 15% yield, has actually beaten the S&P 500 on both share price and total return in 2026. Their Berkshire Hathaway Target Income Fund, ticker OMA, has also tracked Berkshire's stock well and delivered a higher return than Berkshire itself, year to date. Those are more positive results and suggest that the underlying security selection matters enormously in determining how these target income funds actually perform. Part 8. The International Covered Call Opportunity. One development in 2026 that income investors absolutely cannot overlook: international stocks have had a phenomenal year. While U.S. equity markets have struggled with volatility and drawdowns, international markets have significantly outperformed, and covered call funds that have captured that exposure have been genuine standouts. IDVO by Amplify, the only international covered call ETF I am currently aware of, has delivered a total return of 12.07% year-to-date, with distributions reinvested. To put that in context, that performance would have placed it just outside the top 10 list we looked at earlier. That is a remarkable result for what is essentially an overlooked and underutilized category. For income investors who are serious about building durable, resilient portfolios, international diversification matters. And right now, the only covered call vehicle that provides it is IDVO. If you are currently 100% allocated to US-based covered call ETFs, this fund deserves serious consideration as a diversifying complement to your existing income holdings. Closing thoughts: what 2026 has taught us about covered call ETFs. Let me pull everything together because there are some clear and actionable conclusions we can draw from everything we've looked at today. First, energy and AI-focused covered call funds have dominated 2026 performance. Both sectors have been genuine standouts in a difficult year for growth stocks, and the covered call funds with exposure to those sectors have benefited accordingly. But single-stock ETFs in those spaces, however exciting their year-to-date numbers look, come with concentration risk that most income investors should not be taking on in size. Keep any single-stock ETF allocation small and selective. Second, in the index-covered call space, the Goldman Sachs funds, GPIX for the S&P and GPIQ for the Nasdaq, have done the best job protecting NAV, but at the cost of meaningfully lower income. The NEOS funds, SPYI and QQQI, offer the best blended combination of high income and still reasonable NAV resilience. For income investors who need both yield and durability, NEOS stands out as the most consistently well-engineered option in both categories. Third, GEPI and GPQ have validated their defensive design in 2026. If you are a more conservative income investor who values stability over maximum yield and is comfortable with yield variability, both JP Morgan funds have earned their place in this environment. Fourth, target income funds are a category to watch carefully. The Defiance funds have shown declining distributions in a real stress test, which is a meaningful red flag for investors depending on those distributions for cash flow. The Vista Shares funds have performed better and deserve recognition, but as a category, target income ETFs are still relatively new, and their long-term track records through multiple market cycles remain to be established. Fifth, do not ignore international exposure. IDVO has been one of the quiet outperformers of 2026, and with international markets showing genuine strength, an international covered call allocation makes more sense today than it has in years. At Dividend Desk, this is exactly the kind of rigorous, data-driven analysis we are committed to bringing you. Because in income investing, the details are not minor footnotes. They are the difference between a portfolio that generates sustainable, growing income over time and one that slowly disappoints you when markets get difficult. If this breakdown was useful, please hit the like button. It genuinely helps us reach more income investors who need to be asking these questions about their own portfolios. Subscribe to Dividend Desk so you never miss a video, and if you want to go deeper, to be part of a community of serious income investors where we discuss what we're watching, what we're buying, and how we're thinking about our portfolios in real time, check out the Dividend Desk community. The link is in the description below. This is Dividend Desk. We'll see you in the next one.